Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about war, oil prices, bond yields, tariff deals, and other variables that could affect the housing market. Logan, welcome back to the podcast, and you're wearing a cowboy hat.
You know, ma'am, we are going to Billy Bob's today,
Yes,
you and I.
Yes, U.S. Bank is having
Yes,
an
U.S.
event.
Bank. Back to Logan here. Yes, we'll be speaking at the U.S. Bank event in Texas this week. So got my cowboy gear out. Whenever I come to Texas, the cowboy gear comes out.
Okay, let us not forget that you rode a horse in like athletic shorts and like sandals or something. Something I will never forget it.
I had shorts and a t-shirt, had sunglasses, and that was the first time I rode a horse since I was like 8, I think. So.
Okay, well, we're going to have to work on this so that when you show up to Billy Bob's, you're not, you look right. So, okay, well, exciting about that, but lots of really interesting and serious things happening in the market. Of course, we've had an escalation. Israel's attacked Iran. And the question is, what does that variable, that global variable mean for the housing market?
Okay, so this is Friday morning. This is a very fluid situation. A lot can happen by the time this podcast comes out. But usually what I like to do is, I go to Instagram stories and we talk about like what the market reaction is, because that's for housing. What traditionally happens, usually you get like a flight to safety. Money goes into the bond market, money goes into the dollar, oil prices spike up. That's what we saw last night. Except the move to the dollar was very, very timid. And the 10-year yield fell a few basis points, but as of Friday morning, I think we're at 438, 437. Not much of a reaction into it, which is interesting because this is not just a mild attack. This is a very, very big attack. And of course, oil prices really, I think at one point were well above 10% last night. It's come down a little bit today. So to me, we always get a rush of people that say, is World War III going to start? Everyone says, no, it's very difficult in this day and age to have World War III with the global economies, right? It took Europe and Japan to rebuild from World War II, and too many countries have too many things invested in to have like a really big war. But usually people think, well, oil prices are going to go up. That's bad for inflation. And, I just want to remind everybody, back in the last decade, oil prices were high for a very long time, many years, until the oil shale boom happened. And the growth rate of inflation was very tame, right? So people have to remember, don't put everything into the higher oil prices and headline inflation will just spiral out of control, because we had higher oil prices and it didn't filter into the other inputs. This has always been like an argument. How much does oil price really filter in? I know the White House, one of the reasons they wanted oil prices to fall is they believe if oil prices fall, everything else will fall. And that's really based on the price that if diesel prices fall, then food prices won't grow as fast or have some disinflation. Questionable on that premise, but in any case, as long as escalation doesn't occur and you get more regional, something like that, this should be a very mild, a short-term event like the others have been in the past. But it is noticeable that the dollar really didn't get much of a kick. A very, very small move higher from last night's lows to where we are this morning. The 10-year yield, very yawning event actually, but oil prices did increase.
Compare this to when Russia invaded Ukraine as a variable that affected the 10-year yield and therefore mortgage rates.
Well, when Russia invaded Ukraine, oil shot up to over $120. Wheat prices took off. Wheat prices taking off is not a good thing. And if you look at a chart, by the way, if you look at a chart of wheat prices, you guys are really going to do that. And oil prices, you could see the Russian Ukraine invasion impact on those things. So we are off a lot from those levels. So we don't see any kind of super spike like that. And again, adjusting to inflation, like oil prices have to get like $450 to match what we saw in the late 70s to compare to constant dollars right now. So obviously it's not that, because it's a regional where wheat was a factor in the Ukraine invasion. So for now, short term, we'll see what happens over the weekend. By the time this comes out, who knows?
I
We
know.
just don't know. I mean, we just don't know over the weekend. This is why we come on Mondays now and do podcasts for that. But it's one of these things. You can understand how a lot of people would ask questions. And again, if anything like that happens, you guys all go to my Instagram. You guys have probably seen I have no life. I'll be showing oil charts, dollar charts, what's going on every hour to the hour. And if this gets contained and it's just, gets done in a very short amount of time, the impacts will be very minimal short term.
So we're about halfway through the year, shifting focus here from that event. We're about halfway through the year. What are your thoughts on the housing market halfway through 2025?
Now, of course, I'm very biased. I'm very happy because inventory is, getting toward the 2019 levels. And again, for me, this always goes back to, February of 2021. The housing market cannot function normally with inventory levels this low. This is a very, very historically abnormal period in time. And just imagine if mortgage rates never got above 5%. Would we have had the inventory growth, right, in active listings? Obviously, now the mortgage rate lockdown people, not you, Sarah Wheeler, right? But people who said that inventory cannot grow with higher rates because nobody's going to sell their home. That's not the case. Inventory has been able to grow in this environment. And we are perfectly fine. If mortgage rates went down to 6%, nobody should be worried. Even if it goes down to 5.5%, there's not going to be what we saw in 2020, 2021, and the early part of 2022. We are so far from those levels. So I remember when Mike Simonson and myself talked for the first time in a podcast, and I told him I believe inventory can get to 2019 levels, but it needs weakness in demand, and inventory can build. We're not at a very normal state. So if new listings grows, weakness in demand, inventory can just move itself back up to normal. And now we have, home prices aren't escalating out of control. It is a more healthy market. And then of course, purchase application data is positive, even with elevated rates. Another thing that makes me smile, because, if you look back in other housing cycles, this is actually very normal. When rates do fall, you can now see demand just picks up because sales are just depressed. So good in that aspect. I know this is a different view than a lot of people, but I always believe in the balance, right? The supply and demand equilibrium, the balance. We lost that. So when everyone was happy because home sales were up, booming, prices were up, that was an unhealthy market to me. This is a much more healthier backdrop. And again, if rates fall, we're in a much better spot to handle that. I'm not worried about home prices escalating out of control ever again, with rates up here and inventory higher.
So I've seen several things this week talking about how the investor share of home buying is down, something that you always point out. It's not like they own all the homes anyway, but that is something that people have worried about over the last few years. So what are we seeing this week? What does the data tell us?
If you look at the NAR's percentage of sales to investors for the last few years, it hasn't really budged much. I mean, much at all. I think this is my opinion on this. People have lied so much about investors' percentage, especially when it comes to Wall Street. And think about the irony that 100 years from now, we will look back and see all these people that said BlackRock was buying all the homes and they bought 0 homes, and Blackstone owns 0. I mean, it is literally embarrassing that we have functioning adults that passed the second grade basically cannot read a sentence. And Wall Street's percentage went from 2.5% to like 0.4% quarterly. So investors as a share, as you can imagine, if you're investing and trying to flip something or anything in that regards, this is not the most easiest environment, especially with elevated rates, cost, carryover costs. What are you going to do? in that. You're going to have to be a real professional at this point. So naturally, the investor percentage with some people's data lines has fallen down. And again, inventory still not anywhere close to the 5-decade average. The NAR looking at 2 to 2.5 million. We're at 1.45. We're going to get to the bottom end of 2019. This is the fourth calendar year of sales being this low. Much different credit market, so much different inventory market out there. It was funny because, the doomers have gone on the Redfin chart so much. And then I always go, okay, so you have a 9% decline forecast. You have a 12%. You guys are using Redfin. Then why is Redfin's home prices still up year over year? Zilch, nothing.
No
right?
answer.
I said, okay, you guys said this is the biggest seller, market in history. So why is Redfin's home price index higher? It's like 3 weeks in a row now. What's going on? Nothing. Zilch, right? So the inventory getting back to normal, positive, right? Supply rising, positive. Doomers who are talking about, we have people who've literally forecasted 3 straight years of noticeable nominal declines, already off by 20 to 25%. And the data line they're using is actually still showing year-over-year growth. Nothing, right? So investors falling as a percentage, you could absolutely be very normal in this environment. But as you could see, the scale that this was going to be, like the mass increase in supply or vertical supply, of some people have said, that was 2005 to 2007. That supply and demand equilibrium made sense, right? Existing home sales were peak in 2005. It crashed. It took a few years to get down, and inventory escalated up to 4 million. I mean, think about where we are. The NAR's inventory data was at 4 million in 2007. We're at 1.45 today, fourth calendar year, right? So things are different. And we always say, always follow people that have forecasted for at least 5 years. Go back and read their forecast, read their models if they have any. They don't have any, trust me. And then you could start to make sense of the supply and demand equilibrium of housing out there. And by today, Monday, hopefully new listings data picked up again. Hopefully I'm not, talking about Monday, new listings data took another soft. We want to see things get back to normal. And this is how a functioning market works. But the investor side was always an overhyped story. And then you have politicians who basically lied to their constituents that Wall Street is buying all the homes. It's a joke, right? If anything, single family rental supply is actually supplied to help rents have disinflation factors, not inflationary factors out there. So the whole last 3-4 years have been embarrassing to watch. Right. It's just not very, I mean, I can understand why the Russians would do it. I can understand why the Chinese and Iranians would do it. But to have American politicians basically lie that Wall Street was buying all the homes and investors are, no. If you're going to blame anyone, blame the biggest home buyers in America for the last few years, and that was millennials, right? Without millennials, you wouldn't, we've done that. We showed people, right? 70 to 80% of home sellers are buyers. Who's the biggest buyer in America over the last 10, 12 years? It was millennials. They don't give you a house. That's how inventory. So there's just there's been a lot of bad housing takes. I thought the investor one was just more of a grift, either by politicians or YouTube doomer accounts.
Okay, so of course we, amid everything else that's going on, we still have talk about tariffs, tariff deals, tariff uncertainty. Where are we with that, Logan, as far as how that affects housing?
Well, I think today Japan came out and says we're not going to do anything until we get all tariffs removed. So again, we don't have like 90 deals in 90 days, of course. But I think what happened was, and somebody asked a good question. Somebody was talking about inflation is going to really take off, and it's middle of June right now. We haven't seen it in the data. So I have to let me explain this on how tariffs kind of work. Let's say LoganMohtashami.com. I sell Chart Daddy shirts, right? And I get all my shirts from China, but because of tariffs, everyone bought a ton of Chart Daddy shirts, and the inventory was already here. I have a massive amount of inventory, and now the tariffs are put on. Well, I have a lot of inventory that I need to draw down. I don't have to charge higher for this. But once this inventory is gone, then the ships are coming now. Then the tariffs come in, and then you could increase some of the prices. So some products are seeing increases already out there. I'm keeping an eye on natural gas prices. That doesn't look very healthy to me. But when you get more stuff being, imported in with the tariff percentage, you get more revenue really from tariff tax collection. Then you start to have more and more products into the system. So I think the people that are surprised that inflation data hasn't taken off on some things, just remember that there's still a lot of inventory that's in-house already because there was so much purchasing. That was one of the reasons why the GDP was so crazy in the first quarter. So over time, that it starts to look different, especially for companies and how they deal with it. It is interesting that the continuing claims data that we saw on Thursday morning, that's at a 3-year high now. And again, continuing claims is, people filing for unemployment benefits, but have been out unemployed for a longer time frame. That looks at a 3-year high, where initial claims is starting to perk up, slowly starting to move up. So we're keeping an eye on that, because if that trend continues, right, because now there's arguments being made that the labor market is softening more than, inflation going up. The Fed is behind the curve. So the next Fed meeting is going to be interesting due to their language change. But I can understand the confusion with tariffs. Just remember, it's a process. It's not like you could just tariff something if there's inventory here already and, the shipments, but, there's all these things that go into that equation. And I think a lot of people are just surprised that the inflation data has been as tame as it is. But if you look at it in that construct, hopefully that makes a little bit more sense.
It does make more sense. Logan, thank you so much for being on, talking through all these different things that are going on that could affect the housing market.
Jack Bauer, what did I say? I put my Jack Bauer glasses on. I went on Instagram and I'm like, it's time to look at dollar, oil, and bond yield charts. Here we go. Chloe, give it to me now. Chloe! Get the charts up, Chloe. Come on, so.
I can still hear that, the 24 phone thing. You know what I mean? Like when a phone call was coming into that. Anyway,
I'm telling you, even Chloe, the actress, when I saw her at a comedian, she was making fun of my hair. She's like, "Whoa, you got too good of hair to be in this room with these gentlemen." So it always falls back to the hair at some point,
It really does. Every conversation. All right. Thank you so much. We will talk to you again very soon.